Hi, how are you? I'm Michael Lee. I have my own firm, Michael Lee Strategy, primarily doing investment management and wealth planning for high net worth individuals. Here's a little, see if I can get this to work. Maybe if you watch Fox Business, you've probably seen me on there.
NASDAQ, and that's what we're waiting for. Michael Lee is with us. Welcome back, Michael. I love to see you again. You're a good man, strong guy. I like your politics, too. Now then, coin...
Oh, let me go back. It's
NASDAQ, and that...
It's my favorite clip ever from Stuart Varney. I spent a lot of my career at Morgan Stanley, working with both high net worth individuals, institutional investors on both the equity and fixed income side, so some tier one buy side fixed income accounts, some smaller hedge funds, and some of the wealthiest individuals in the world. And now I work specifically with families, small business owners, people who've had large liquidity events, putting together their portfolios so that they can focus on generational wealth transfer, and also just staying alive in markets that are increasingly more difficult by the day. So what we're going to talk about is how we're going to define microcaps as investments for the portfolio, the best way for individual investors to get exposure, the effect that microcaps have on both equity standalone portfolios as well as balanced portfolios, which is, I'd say the balance is probably 95% of all investor portfolios. And then portfolio construction, how are we going to actually put microcap investments, if they make sense, into these portfolios, and then how I would approach it. So first, microcaps, the technical definition is 50 million to 300 million. This exercise, we're going to go a little bit higher, but only focus on U.S. traded stocks. So there's two pretty big ETFs out there. I don't know if I call them big ETFs, but the IWC, which is run by iShares, that is BlackRock, that owns everything. It tracks the Russell Microcap Index, 900 million in assets under management, 35,000 shares average daily volume. It's not huge volume, but it's enough. And with an ETF, when you're thinking about volume, you have to think about the volume of the underlying. So as long as the underlying securities behind the ETF have good enough liquidity, you're not going to be liquidity constrained, because it's very seamless the way that these large firms create and redeem. If you send a buy order for, say, 50,000 shares of this IWC, they'll just create new shares instantaneously. Same thing as if you want to sell 100,000 shares that exceeds a daily volume, or what they have in inventory, or what they can easily cross, they'll just do redemption units. As long as the underlying, that's what you need to focus on with these ETFs. And then the First Trust also has a microcap index. It tracks slightly different, the Dow Jones Select Microcap Index. It's a smaller, only 173 in AUM, and a little bit smaller volume. I duplicated the slide in my presentation. And then there's two mutual funds I'm going to use for this exercise. So Oberweis Microcap Fund, almost half a billion in AUM. They've been around for a very, very long time. But they'll do what we call style drift, is they'll own companies that are small cap. So if you have a microcap company, it's a $200 million company, and it doubles or triples in value, they won't sell it because of the value appreciation until it's completely above 500 million. And then the Paradigm Microcap Fund, it's a smaller fund. It was incepted in 12/31/2007. 80% of their investments in microcap. Just a little bit of a spoiler alert, these are unbelievable mutual funds. So just if you're thinking about investing for yourself, both these funds have unbelievable track records. So when you start looking at this, obviously individual security selection, if you have the inclination, or you're able to value these companies and understanding the underlying the underlying assets and where the marketplace is going, and you can pick microcap stocks and you have a knack for it, by all means. But the majority of investors are going to use some sort of product or vehicle to get into it, and then the debate goes, well, do I want a product with active management or a product with passive management to get myself exposure to this asset class? So when you're looking at large cap stocks, large cap growth stocks, aside from like the last 12 to 18 months, it's very difficult for a manager to add any value above and beyond what the index is going to do. So how many asset managers beat the S&P 500? Well, last year, if you owned the Magnificent Seven, you made 50% more, so there's your case right there. But more often than not, in large cap equities, you just want to own the ETF because it's basically free to own it. It's going to track the market one-to-one, so it's very difficult to get on top of it, okay? Once you move away from large cap equities, the case for active management gets greater and greater and greater. And you see greater performance disparities where in small cap or mid cap or emerging market fixed income that these benchmarks aren't necessarily as well designed to versus a large cap index. So it becomes very, very difficult, it becomes much easier as you move away from, say, the S&P 500 to outperform. And especially when you get into a little bit of an esoteric asset class like microcap investing, there's a tremendous amount of value that can be added with active management. So if you look at this chart, what you have three lines on here. You don't need to see specifically what they say. The two on the top are the two mutual funds I just mentioned, and the one on the bottom is the BlackRock ETF. So there's the BlackRock ETF, is a fraction of the performance, which tracks the index. It basically hugs the index, a very small tracking error, versus the mutual funds where they spectacularly outperform the index. So this is kind of just proving the point that I just made, is as you move away from large cap equities, it makes a lot of sense to get involved with active management. All right? So microcap, superior security selection from active management, when you add it to an overall portfolio, it dramatically increases your returns. There's a lot more, as you move away from these large cap stocks, okay, as you get away from these bigger names that everyone follows, the opportunity to uncover inefficiencies in the market gets greater and greater and greater. So it would make sense that microcaps can be extraordinarily return additive to an investor's portfolio. Smaller companies, they have longer runways, right? And like maybe we're in a very unique situation right now where Microsoft, as a $3 trillion company can grow at 15-20% per year, but that's more the exception than the rule. Whereas when you have a $100 million company, for that company to potentially become a $1 billion company is a lot easier than for a $100 billion company to grow 10x. So, and then inside of that, once you move below $1 billion, 500 million, you start to exclude a lot of institutional investors with their investing mandates. So you become much more of what I call a dark market. So there's a lot of inefficiencies in there, and superior security selection can really be return additive. Oh, there we go. So before I worked on my own, I worked at a very large registered investment advisor. And so for those of you unfamiliar with the wealth management industry, it's transitioning from your Merrill Lynch broker, your Morgan Stanley broker, to what's called a registered investment advisor, fee-only fiduciary advisors that manage money. This portfolio is a result of like a 12-person investment committee with billions of dollars of AUM. Very, very similar to what I think you'll see at about 95% of large registered investment advisors across the country. Okay, what I did for this exercise is I added 10% of the Oberweis microcap fund to see what that would do to a 60-40 portfolio. So 60-40 portfolio, for those of you who may not be familiar, that is 60-40 is supposed to be your northwest corner mix between stocks and bonds over time. for your maximum Sharpe ratio in terms of the mix of stocks and bonds, i.e., where am I going to get the most return per unit of risk between stocks and bonds? And so some say the 60-40 is dead. It's a different conversation for a different time. I assure you, there are scores of RIAs and advisors using 60-40 as their model. And what I did in this exercise is just to point out how additive microcaps are. So what you're looking at in these two screens is the efficient frontier. So from left to right, you have risk, okay, and from top to bottom, you have return. And the efficient frontier is from Markowitz optimization for anybody who's unfamiliar, but this is just a map of how all these assets and the different combinations have played out from a risk-reward standpoint. And so in there, you see two dots. One's with microcap, one's without microcap. The one to the farther one has microcap, and you see the provided portfolio, the max Sharpe ratio. They both move. It adds volatility, so you're moving further out the chart, but you're moving further up the chart. And so the idea is, how much extra return am I getting for all the extra risk that I'm adding? So this, to me, this is how I build portfolios. This is what I look at before I examine things. I looked at this. It's not a long presentation. I don't have 2 hours to explain to you what it does at 3% in allocation, 5%, 12%, 20%. To me, I found this to be the ideal allocation. But if you look at this on a trailing 5-year basis, you're adding over 100 basis points of return on an annualized basis. And that standard deviation, which is the third number from the top, you're really not adding a dramatic amount of volatility for the extra return, right? We're adding about 50 basis points in volatility, while we're adding 100 basis points in return. And on a proportional basis, it's absolutely worth it for me to do something like this for my client. And like, you look at the maximum drawdown, it's less. And I think, if you're sitting there and you're looking at a portfolio construction, and I want to add either small cap or mid cap versus micro cap, those are highly trafficked. There's a lot more players in those spaces where micro cap, you're essentially looking at the identical factors, but it's a lot more of an inefficient marketplace, and these companies have a lot more room to run. So over time, it's extraordinarily return additive to add these to your portfolios. There's a big player in the microcaps, dimensional funds. They've written a ton of white papers on it. Let me go back. Both of these Oberweis and Paradigm do substantially better than Dimensional. And so Dimensional can sit here and talk, like Dimensional's done quite a bit of research on the benefits of microcap investing and what they can do for you. But they use factoring. It's a closet index. Active management destroys them from a performance standpoint, both on a risk standpoint and an overall performance standpoint. And so this adding microcaps to an investor portfolio, other than Dimensional Advisors, which is almost like a cult-like group, they're the only people I know of that are actively adding microcap investments to an overall portfolio. So it's a huge opportunity for guys like me to differentiate themselves. It's a great opportunity for individual investors to add something to your portfolio to really juice up your equity returns without adding a tremendous amount of risk. And so if you look right here, this is just the same chart, and that black line at the top just shows that over a 5-year period, how much more this adds to your portfolio. And I would say this 5-year period is probably one of the best 5-year periods to look at trailing returns for an idea of what things will look like in the future. Why? 2019, spectacular year in the market. That's when the Fed pivoted at the end of 2018 after a pretty ugly year. So kind of raging bull market. 2020, obviously, all the drama with COVID. 2021, everything goes crazy. 2022, just a total and complete devastation of risk assets. The first time bonds, like a negative year in bonds since the 90s, one of the largest negative years for fixed income returns on the record, rising interest rates. And so if you think about Fed tightening and rising interest rates to the degree with which they rose, who does that hurt? That hurts firms with the least access to capital markets. Okay, their borrowing costs explode. So microcaps definitely fall in that space. And in 2023, we didn't get a pivot from the Fed, but markets certainly recovered. And what you saw later in the year was this talk of that Fed pivot, and that's why you see the market running substantially at the end. So a lot of different market environments in this example. I looked at this also from a 3-year and a 10-year, and you get very, very specific, or very, very similar results. I'm just, for the sake of time, we just use this one example. I ran this also at 3%, 5%, 10% of an overall portfolio. And to me, the sweet spot is 10% of your overall portfolio, or roughly 16% of the equity allocation in what is a 60-40 allocation. And so when I'm building a portfolio, it's not just what's going to make the most amount of money or what's the least amount of risk. It's where can I find that sweet spot of risk and reward, and what's going to be additive to my clients' overall performance on a risk-adjusted basis. And microcaps, absolutely, like, they're super return additive to the point where I knew it would be beneficial when I started this exercise. I was a little bit surprised to the degree. I got a minute and a half left. Yeah. The microcaps need to be part of your equity allocation. It's a great diversification tool. It has a lower correlation to the S&P 500 than mid-cap, small-cap, or international. So when you talk about diversification, what you really should be talking about is correlation, right? So if you have 3 different funds in your portfolio and you're trying to be diversified, if they all have a correlation of 0.98 to each other, I mean, what's the point? So it's substantially lower than all those other asset classes, which in itself is a reason to put it in there. And given the return possibilities, the historical returns, it's absolutely something that individual investors need to have as part of their portfolio, assuming they're going to own some equities, right? So I don't believe I have a ton of time for questions, but anybody want to ask? So I have an office in New York City, but since COVID, I've become a Florida man. So I'm in New York a lot, probably half the month, and then Florida as much as I can.
I'm part of an investment committee in a couple of endowments, and instead of microcaps, we focus more on venture capital investing for sort of that barbell type of an approach, 5% in venture capital, something like that. Can you speak to how microcaps would fit into a strategy where you're already taking some risk in sort of a VC type of an asset class?
Well, so I wouldn't compare it to VC, right? I would take the money from international EM, small cap, mid cap, right? And those mutual fund companies, depending on the size, you could probably like if it's, if you're getting into the 8-figure range, you could probably get an SMA agreement with them. And I would live more in that space because the small cap and mid cap, like these are like, it just falls below so many people's guidelines that the inefficiencies in small cap and mid cap get taken away. And so it's like from a technical standpoint, when you're looking at the portfolio statistics, it's unbelievable how much it takes down the correlation of everything else, and being so return additive. And I maintain it's because people have that viewpoint, well, why am I going to be in microcaps when I can either be in private equity or venture capital? Whereas, you know, on a longer timeline, they destroy these other asset classes. And so, you know, with the way kind of, so if you're looking at it from an endowment standpoint and your equity allocation, what's going on, in my opinion, in the Magnificent Seven is simply that the latest technology trend, right? What's gaining wallet share of this $5 trillion global enterprise spend is artificial intelligence, the cloud, right? And so the biggest companies are getting so much bigger because they're the best positioned to profit from this. And then so by not having this allocation to the mega caps, you give up a lot of available equity return, but you're not going to have 100% of your equity allocation there. You're going to kind of look to other spaces. And I just think microcaps, obviously, you can't just barbell, you know, the Magnificent Seven and microcap, but I would have smaller allocations to international, smaller allocations to mid-cap, small cap, and work in this microcap space because it's, you know, from a risk standpoint, you're looking at like an extra, so we can go back to that example of, you know, you're adding very little extra volatility to your overall portfolio and you're taking correlation down. So, you know, you're not necessarily moving that frontier up and to the left, but there's a lot less correlation to these big names than there are the other. Did anybody else have another? Okay, well done. Okay, awesome. Thank you, guys.